Hello! Are you trying to understand volatility in stocks or other types of subjects in the financial markets? Well, there are many different ways to understand volatility. My name is Jimmy Lapping. I'm a psychologist and statistician with an interest in a wide variety of research topics, including the financial markets. And in this video, I share a perspective on volatility that I have found helpful in recent years. So here you see an example of a price trajectory of a given stock on a given trading day, but you could apply this figure also to other time units, for example, trading weeks. Within each unit, there is a highest point, a lowest point, a difference between this time unit's close and the previous time unit's close, the difference also between the open and close of this time unit, because the open of the current time unit is often not the same as the close of the previous time unit. And there are different ways to understand volatility, but I like to use a function, among others, a function of the percentage difference between the high and the low of the time unit. Now, some may wonder, okay, if we express volatility this way, what if something goes up or down in a straight line? Then the difference between open and close is the same as the volatility. Well, in the stock market, things rarely go up or down in a straight line. Yet, to account for this kind of questions, and well, frankly speaking, rare situations, we can also compare differences between time units and express volatility as a function of these inter-time unit differences. Not intra-time, which was the previous picture, but inter-time unit differences. That is, the bigger the difference in time unit differences, the higher the volatility. Now, what I am going to show in the remainder of this video is that although volatility is not necessarily a good predictor of the direction in stocks over time, up or down, there is a good correlation between the intra and inter-time unit volatility that I just conceptualized. And there is also a good correlation between differences in shorter time units and differences in longer time units. So I'm going to show this with an example of 15 stocks from the Amsterdam Stock Exchange that together represent 11 sectors and a variety of industries in the international stock market and cover large, mid and small cap companies over the past trading year, being from the 24th of May last year until the close of Friday 24th of May this year, 2024. You see the codes of the stocks included in this sample on the right, so you can see which stocks they are, for instance via Yahoo Finance by typing the code followed by .as because they are listed. Then you see how they are doing on their Amsterdam listing and not, for instance, in US dollars for the few that are listed in the US under a similar ticker. Okay, so what we see here in the chart on the left is the dividend adjusted percentage difference between yesterday's close and that of a year ago on the vertical axis, and the dividend adjusted median percentage difference at the level of trading week on the horizontal axis. And in the chart on the right, we see the dividend adjusted week to week percentage difference on the vertical axis and the median day to day percentage difference on the horizontal axis. Both charts show a clear positive relation between the differences of these different time units, day, week, and year. Now, these findings are not surprising and do not yet indicate much about volatility, but I'm showing these because we will see in a minute that the charts for different volatility units are quite similar to what we see here. And here we start. In the chart on the left, we see on the vertical axis the median logged percentage difference between the high and low of a trading week, and on the horizontal axis the same but for trading day as time unit. Next, in the chart on the right, the vertical axis presents the logged percentage difference between the high and low of the trading week, and the horizontal axis presents this for trading day as time unit, and we split it out for different stocks on the right. Well, either way, we see a clear positive relation between these two volatility measures, and well, from the picture on the right, it seems that this holds for each of these stocks. Next, to examine volatility from a different angle, the vertical axis of the charts here expresses the intra-quartile range of time unit differences. So that's a measure of spread in time unit differences. And the aforementioned logged median percentage of difference between high and low of the time unit on the horizontal axis. The time unit here is trading week on the left and trading day on the right, and we see that the chart is very similar for these distinct time units, clearly positive correlation. Next, here we see in both charts the interquartile range of week-to-week differences on the vertical axis, and on the left the interquartile range of day-to-day differences on the horizontal axis. On the right, the aforementioned logged median percentage difference between daily high and daily low on the horizontal axis. And while whether we use Pearson's correlation coefficient or Spearman's rank correlation coefficient, we are dealing with correlations well above 0.8 here. Then here are two charts to examine how the logged percentage difference between daily high and low on the vertical axis changed across trading weeks in the past year. And we see that although individual stocks can show increases or decreases in this volatility measure in specific periods, which of course can have different reasons, including several reasons linked to the company itself and or the industry or sector in which it operates, but averaged across these sectors and industries as displayed on the left, we do not find major differences in this volatility measure in this 1 year time window. And here the same picture for the logged percentage difference between weekly high and low on the vertical axis. So here the time unit is week instead of day. Basically to show that these patterns look very similar to what we just saw when we took trading day as volatility time unit instead of trading week. This looks really pretty similar. Then finally here a few charts resulting from multi-level models in which we treat the 15 stocks and their repeated measurements as hierarchical levels. Top left we see a chart that we started with, similar to what we started with, and shows the relation between median day-to-day differences horizontally and week-to-week differences vertically. And we find a correlation close to 0.7, which is fairly good. And then top right we find a similar pattern for the logged weekly volatility vertically and the logged median daily volatility horizontally. So week vertical again, day horizontal, and here we are dealing with a correlation of over 0.8. So a clear positive correlation between these volatility measures as well. And finally, the two charts below compare the week-to-week difference on the vertical axis and the logged median daily volatility on the horizontal axis. The difference between these two charts below is that on the left we have a model that does not include day-to-day differences, whereas on the right the model does include those day-to-day differences. But either way, we find no clear, strong relation between volatility and direction, indicating that it is not clear-cut that more volatility is a strong predictor of better or worse performance. We could run many more analyses and charts, but what should have become clear at this point is that not only difference statistics at the level of day, week and ultimately year are quite positively correlated, but the same holds for the daily and weekly volatility measures that I propose in this video. Of course, this is just a 1 year sample of 15 stocks in a specific European index, but several companies included in this sample are also listed on other stock exchanges either in Europe or elsewhere. And if you repeat this exercise with other European stocks or perhaps also non-European stocks, you could get similar findings. The finding that there is a clear positive correlation between different intra and intra-time unit volatility measures is interesting, among others, because it indicates that for daily volatility measures, in this case, daily volatility measures are not useless indicators of weekly volatility measures. Which is to say that by understanding daily volatility, you may to some extent understand weekly volatility as well. Another way to interpret is that, okay, apart from temporary factors related to a company, industry, or sector, these temporary factors which may contribute to increases or decreases in volatility statistics, as we've seen earlier in this video, a stock that is relatively volatile in one period is also more likely to be relatively volatile in other periods. That said, I think that's a nice point to end this video. I hope you find this useful, and if you have any ideas or suggestions for future videos, you can leave a comment below this video or just drop an email using the email address shared below this video. Thank you for watching, thank you for listening, have a good day and see you soon.